Hello and welcome to Equities Bank. My name is Jonas Thulin. I'm a head of asset management, and I will, as briefly as possible, walk through how we position and why. First of all, what I want to mention is just to take a little bit of a rear view mirror on the banking crisis and the banking turmoil, where we could see this weekly change data, so we could see massive outflows from large and small US banks and inflows to money market funds. This is the trigger why the Fed, the US Treasury and US policymakers went out so aggressively and made these huge packages of stimulative factors. Not only because of the banking stress, I would argue, but also because the money was flowing into money market funds. They are not always US. So this became also a question of, should we keep the capital within the US borders, or should it go out so not only do you have a bank run, but you also have a bank run on the US as such. That is probably a good reason why they went out so aggressively as they did. And this is quite interesting because this is not at all how we work with currency in Sweden, for example, or in many parts of Europe, but this is a very US and Chinese way of thinking in terms of how do you want to work with currency, what is the status of your currency, and then in terms of value, and pretty much do you see it as an asset or not. The packages that came out, huge, and this is just a few examples, and I just put up what they did in 2007, 2008. Obviously these have been huge and they were quite immediate and quite aggressive. Back in 07 and 08 it took a couple of years before you actually could see the packages rolling out. In the pandemic it was a matter of a couple of weeks, and this time it was a matter of a Saturday and Sunday. So the impact of financial stress, the current impact of financial stress from the banking turmoil in the US was that we moved up a little bit and then we moved down, and now you pretty much went up this morning, you're back to pretty much where we were before the banking crisis. Not at all comparable to the stress that was caused by the rate hikes. Obviously the one led to the other, but you see where I'm going here with the drift, that this created a massive bear trap if you downshifted your equity allocation or you became too concerned and too pessimistic. If you want to really stress that argument, you can look at this data, which is the Financial Stress Index from the Office of Financial Research in the US Treasury. And this is the, almost looks like a matchstick, right? This is the banking crisis. That's it. Not at all comparable to what we saw in 2022 in terms of market volatility, in terms of rate hikes. Not at all comparable to the pandemic, or for that matter, the Chinese liquidity issue in 15-16, or the European sovereign debt crisis, or obviously the great financial crisis, or the preconditions we had in 2000-2001. So if you blow out that small proportion, it looks like this. So pretty much you had an issue going into the 10th, 13th and 14th. On the 14th, everything turned for the better. And I will show you later on exactly what that looked like. That means that we then remained cool for one day, 15, and on the 16th we always start to wait even more to US tech, and we continue doing that on the 20th. The reason is that we can see that when we split up the stress data or financial conditions that we count in numerous ways, we can see that everything troughed and turned or peaked and came down again in terms of stress. That was key to us. So weirdly, the banking turmoil with the resulting packages that were sent out in the economy created almost an abundance of liquidity. That created that the banking turmoil pretty much meant that you should, if possible, increase or hold your equity exposures, but also rotate into US tech. Quite counterintuitive if you look at the sense you get from media or whatever, but I'll explain that a bit more, because we are far from being bullish in this environment, far from being alone. But it's quite interesting how that kind of turmoil ends up being a buying opportunity, or remain cool, and a totally 100% so far bear trap. Could it be long-term effects of the US? Yes, and there will be long-term effects of the liquidity in the system, and there will be long-term effects of the time that we saw the responses from the US policymakers. So we can't look in on the negative side of this issue and extrapolate that and play around with the idea of what if you see a credit slaughterhouse in the US financial economy, because obviously that has to be counterweighted with the abundance of liquidity. So it's a quite interesting conclusion that we come up with in terms of what happened, why did tech go so well. In fact, if you break down the intraday moves on a 60-40 portfolio and you sort of clump it into the monetary policy news, economic activity news, there were few days where I actually saw a stress. There were a lot more going on the top side. So you can't even, I would argue, derive a negative outlook for the equity market in the heel things. You had probably one day, the 14th, where you sort of had to see things turn around, and it turned around with perfect timing. And right now, there's pretty much nothing that goes on the downside. And that could be the case for the next 6-9 months. It could be the case for the next couple of weeks. Our point is that we follow data, and unless that turns lower, we will not go into this kind of nervousness or experienced fear in the market. I think this is really a proof to the testimony that you have to stick with data and look at what's actually happening within the system. Because this is probably, well, apart from the trough from the pandemic there on 24th of March 2020 with a V-shaped recovery, which I think an abundance of people missed, I think this is a good example again of data just being faster than humans. So if that's the case, we can then focus on CPI and GDP, which we sort of were focusing on before the banking turmoil. Obviously, everything that has to do with CPI is rolling over. Yes, I know there have been attempts to look at core, sticky, excluding shelter, whatever. Everything is rolling over, as it always is. And there's no statistical relationship. The unemployment rate has to go up by X% in order for inflation to move down by Y%, that some people would argue. As long as there is no relationship with these two parameters, we will not put money on it, but rather follow the falling inflation that's happening right in front of our eyes. And this is just wage and inflation in the US, which took away a full percentage point. In Sweden, we actually have peaked inflation as well, which is quite nice to actually have seen that. And the fall down in inflation will be quite rapid, which is quite interesting if you look at what's being priced and forecasted from the Riksbank, and I'll show that later on. So what does that mean? What does the banking crisis mean for the cyclical outlook? Well, so far, not much. Because even though there's a risk of increased or decreased credit or sort of a credit cycle that sort of goes sideways in the US, that has to be counterbalanced by the liquidity being sent out in the system. That has to be counterbalanced with the lower yields. That has to be counterbalanced with the lower priced Fed. And also you have earnings revisions going positively again, moving upwards. That means net everything, we're pretty much unchanged in terms of recession outlook. So we still have 20% recession probability in the US. The market is 65, so we are far lower. The Fed is even lower than 20%. Unless this changes, we will not sort of throughout the data and run around being all scared and nervous. That's the worst way of managing money. So for us, we're going to stick to data. As long as the data holds, the market will hold. The soft landing that we see is still there. We're still going to see negative growth in industrial production. We're still going to see a softening in US retail sales, but we always knew that. We're going to have a soft landing. You're going to have a heightened recession risk, but then obviously you're going to have rate cuts from the Fed. Because do remember that even before the Fed started hiking rates in March 2022, the market already knew they're going to cut rates end of 2023. That is because the whole CPI cycle is that easy to predict where it's going. You could have put your neck out here and say it's transitory, but I will not do that. But that argument is sure to come back again given the speed that CPI is falling. And if you look at what's happening now to Europe inflation or European or Swedish, they're actually going to see even it kind of turn lower, more slow pressure than in the US, but still lower. So still a soft landing, nothing has happened here. If you take the concerns seriously and say, well, what about we have a credit event? We can actually, or credit cycle event I should call it, you can actually pinpoint those and calculate that, and the Fed is doing a great job on this, and they say we're going to go through all the credit market spreads, liquidity and everything, and you have a 17% risk of a recession in the US. The economic consensus is at 65, actually a bit lower now. This spread, it means a couple of things. One, someone's going to be wrong in the market. Two, the economic consensus has been awful to try to make money on, because obviously to be in equities is the right call. And that gives sort of the Fed model one up there. And I think that the development here going forward will be quite telling. What if the economic consensus has been absolutely horribly wrong in predicting a US recession? What if you're going to get a soft landing? Given the fact that we already priced the recession in 2022 and we are priced, or sort of we have a high expectancy of a recession, the risk reward is always going to be on the other side. And if that's manifested or strengthened by data, that's where the market's going to go. That's our view. And so far, that's been validated since June of last year, when we saw the trough in our global equity portfolios. Do also remember that the global business cycle is shooting to the north, obviously led by the trough in Europe and China and elsewhere. So it's quite interesting macro backdrop on all this, and obviously the US is responding. This is the weekly updated growth data. So you saw the downturn. The lowest point was in the end of Q4 in 2022, which interestingly is where people are now putting the trough of the EPS cycle for US companies. In Sweden, yes, you might see some upside, which would be great, because obviously we are the weakest card in terms of growth in Western Hemisphere. So it will be quite interesting to see if we can actually manage to get a bit of an upside surprise, and obviously lifted by the manufacturing side with Germany and Asia, etc., etc. So when we look at single equities, we will look at those with a huge international exposure. This is just sort of a nerd level on data, but it's quite interesting to see that the March move shaved off some GDP, and now actually I updated this morning, so you're back above north of 2.5%. So the macro effect of the banking crisis, if you compare that to the pandemic or compared to Lehman or anything else, it's hardly visible in data so far. And we have to work with this every single day to see if that view is going to be maintained or changed. And yes, we're going to have upwards revisions on US GDP growth. We have that. Obviously, this means upwards revisions on earnings revisions for companies. Great. The equity market responded quite well back in January, and we think it's going to fall back to that. Also in Germany, not so much in Sweden. This is macro. Fortunately, Swedish equities are trading more on US than Swedish outlooks, which is obviously a good thing. In terms of data, we have a whole bunch of data, especially next week. In terms of US GDP, you have core logic house prices, obviously been interesting in terms of the shelter component, owner's equivalent rent in the US CPI, you have the PCE deflator, etc. In Sweden, you have the GDP indicator, retail sales, and Riksbank. But obviously this week, we're going to look at PMI in the US. That's going to move up 1 point. You're going to have PMIs in Eurozone and Europe, and then we're going to look forward to GDP growth. PMI data has been troughing since actually European equity market took over from the driving seat from the US back in October, November last year. So there's nothing new here really. We believe the PMI will keep on climbing upwards. We do not believe the ISM is giving a better picture of the US economy. Why is that? That is because the seasonal adjustment methodology going into ISM is vastly different from the one going into industrial production numbers, which means that you have an opening gap on the downside between ISM and industrial production. It doesn't make sense to us. So we think the ISM will trough and turn around. And we should also remember that this has already been fully priced in the equity market in terms of ISM at 46, 47 levels. PCE rolling over, nothing new there. GDP growth in Europe is going to go through a soft patch or even recession in Sweden. But please remember that this is nothing that's going to move the markets. The markets will look at indicators that are moving upwards. In Germany, for example, you don't see a recession. This is a very, very nitty-gritty and a quite stressed GDP model. And the IFO is turning up versus boom again. So the market is looking at indicators to be able to look into the future rather than looking into what's actually happened to GDP, which is sort of backwards looking. So that's, I think that's worthwhile keeping in mind. Yes, we know that German GDP will hit a soft patch in 2023 before rebounding, and that rebound that official forecasters are seeing has sort of been visible in the chemical industry, which is a great leading indicator for German basket or European basket of industrial companies. So obviously the market is now focusing on these type of indicators and data around the GDP forecasts. In Sweden, we're going to have a soft retail sales, but then do remember that we already had a recessionary consumer even before the first hike from the Riksbank, so this is nothing new, and that is because obviously the rate hike in Sweden is killing off the consumer quite rapidly, given that fact that we have a record high debt service ratio, i.e. how much of our income, the share of our income that we need to spend is to roll out debt. So this is a quite surrealistic thing we're doing now in Sweden, trying to kill off a supply-led inflation spiral by keeping up the rates with a debt service ratio that's so high, with a plummeting, already before the first hike, plummeting retail sales. But that's what we're doing, so obviously we want to be a bit careful here in terms of single equities that we choose in Sweden. In terms of the Riksbank, they're going to hike, and then the market is anticipating cuts going into 2024. That's quite interesting to see. If we see the last hike now, they're probably going to move 50 basis points next week. And then it's 50-50 pretty much for another 50 basis points in June. And then we're going to roll over and join the cuts that's going to come through from the US and ECB. Which makes the currency a bit interesting right now, which we have a quite diversified view on Swedish currency in our global equity market portfolio. Chinese growth will obviously take off on the upside. Nothing more that we can comment on this. If you look at equities, what does that mean? Well, if you calculate the relative performance between a 60-40 portfolio and a 40-60 portfolio, obviously when we hit the banking turmoil, our first initial course, okay, should we change the strategic asset allocation weight? Should we go from a 60-40 to a 40-60 portfolio? The answer was a screaming no. There's not enough statistical evidence for an outperformance of a 40-60 portfolio in that time frame to validate that. We saw a scare, this is a risk indicator, for one day, and then it shot back on the upwards. So we had 1 day of full alert, and then it went over. And we came into this kind of reallocation and adding risk perspective. We can skip that, but I think it's also quite interesting. Another outcome of the banking turmoil is that our yield model is now going actually south of 2%. And that looks a bit greedy in US Treasuries. So obviously, we long US Treasuries from 4.2%, so it's been a good, bad, good, bad. Now it's a great trade, so a good trade at least. Interestingly, we're going to keep that in our book because obviously that was a great cushion to have in the March turmoil with this kind of huge down push that we saw in the first couple of days, and that has continued, given obviously the CPI outlook, for example. That we've been pushing lower and lower in the yield model is depending on CPI, not growth. And I think that's quite, because sometimes people make the argument that yields are falling lower because growth is falling out the door. Yes, we're going to have a soft landing, but don't forget the main explanatory power behind the move in yields in our mind is the CPI momentum. This is just to show you that we had almost a repeat of October 2022 from October the 13th, that we saw this massive shift in terms of hikes or no hikes from the Fed. We had this idea that in May the rate might be 550, 575 to a small percentage point, but that's what we had when we moved into the banking turmoil. Obviously that has been quite aggressively reversed in the market, which also has to be taken into context when you look at the scare for equity markets. Obviously, this is a huge positive factor here for the equity market. Another interesting thing that I want to show you is this black line, which is the equity sentiment in the US, but we also combine it with flows. Because what we have experienced a lot is that people have a tendency to give expression for being bearish or concerned or nervous, but then when you ask them the follow-up question of how much of your portfolio are you short? Are you shorting 10, 50, 50, 70%? Are you 100% short in your equity portfolio if you're so concerned? The answer always becomes pretty much zero. So what we're doing here is that we combine the sentiment with flows. So you had a little bit of a scare, not so much, during the banking turmoil, and then rapidly people realized it's a buying opportunity. So I think this is a neat way to extracting what people are saying combined with what they actually are doing in terms of being bullish or bearish. Now you can also take this from another point of view, is that look at the conditions in counterparty risk, dollar liquidity and vol curves, and you can see that we're back to where we were in January, February. And you had one scary day, that was the 13th, and then everything became quite cool on the 14th. And then we waited another 2 days to lock in the signals. So on the 16th, we allocated more to tech, and also on the 20th, as the indicator moved on the upside. So it's really a question to are you following data enough so you can see these twists and turns in the market, rather than being overly bearish on a long-term theme that might happen or might not happen. If it's going to happen, we will see it, and then we have a chance. Because the risk otherwise is that you sit on one side of the fence and being bearish, or bullish for that matter, and the darn thing never happens. And once it happens, people that were bullish all along, then they join you in the bearish camp, and they're still going to end up winning in terms of the portfolio. So it's really, I think this is a great example of a numbers game. And this graph is super important for us. The green line, when it's climbing, this Hubel ratio means that people are more stressed to miss upsides than they're stressed to miss downsides. So you can see here in 2021, for example, people are really expressing a negative view almost before the equity market starts to roll over. And then now people are really chasing the upside. And I think that's a great sort of buying statistical fact to have in mind, that if you're going to turn bearish, by all means do that, but the market is more concerned of buying than selling. So that means that you're probably going to be pretty alone. You might not be verbally alone, but you're going to be flow-wise alone. And that's obviously the right answer at the end of the day. Institutions are buying. That also gives a good buying sell signal for the equity markets. And most importantly, earnings revisions did trough back in June, July, when we made the call. That's where we had our global equity portfolio bottom up, and also now we're obviously been climbing. And you can sort of start to realize now what people are making the argument that maybe earnings troughed in Q4 of 2022. And then they're going to be looking a bit better. And actually, we think that the earnings season will be a beat on that we currently are having in the US and elsewhere. And also do remember that earnings revisions, this data actually leads the equity market. EPS forecast or forward P or forward EPSs actually lag equity markets. So we are not too concerned about EPS forecasts or whatever, because obviously we want to be able to trade on the data. Price target revisions also turned up. So why all this happening? Well, it happens because the equity, not the equity, the actual companies are expressing views that are a lot more bullish than the market has caught on to. So if you look at, for example, what all the companies in S&P 500 are saying in terms of sales and earnings, they are way more positive than we can see in how much of S&P as a percentage that have positive surprises. So we believe the blue line will lead the gray line, so you might actually end up with a positive growth in terms of surprises momentum, which would be quite interesting. And certainly the banks haven't failed us so far, but we have long ways to go. But it's quite interesting also that this is not an abnormal way of looking at things. This has pretty much been the business cycle for the last couple of decades. So we think this is a quite interesting way of looking at things, especially as earnings revisions are so coincided with the macro momentum. So we also want to keep people remembering this, that yes, macro will look bad in Europe, but that's been priced, and if you look forward, it looks good, and the global outlook is looking a lot better. So we have to keep following data, I think. With those comments, I will leave you there, and I wish you all a great week, and we will be back in a couple of weeks with an update and see for how long we will keep our tech exposure, and if we have changed our equity weights that are right now at maximum overweight, and they have been actually throughout the banking turmoil. So far we're quite happy that we didn't sort of sell off a bunch of positions and then had to buy them back in again. Obviously that will cost our customers a great deal. So far so good, but we take every day as new, and we fill it with data. Thank you so much for your time.